Okay, so good morning everyone. Today we are going to discuss the problem number 12. So before I start this question, I just wanted to, make it very clear with regard to, okay, some few important points which are relating to the capitals. Okay. Whenever we look into the admission of a partner, as we know that a new partner joins into the firm and he brings along with him, okay, because as he is also entering into the firm, so he brings along with him the capital to have a share in the assets of the firm, as well as goodwill to have a share in the profits. So far whatever the questions which we have solved in that, directly they have mentioned as what is the amount of the capital or the goodwill which is being brought by the new partner. But the question which we are going to right now look into in that, okay, I'll just read out and you are going to tell me what is the exactly the difference here. Because sometimes it so happens, as I said, it is with regard to the capitals. So here there are two circumstances, okay, on the basis of which you are going to, okay, adjust the capitals. The first will be, okay, the old partners, I repeat once again, the old partners capital are going to be adjusted on the basis of the new partner capital. Okay, so the first adjustment with relating to the capital here is the old partners capital are going to be adjusted, or it is also to be meant as the old partners should maintain the capital in accordance with the new partners capital. What does it exactly means here? Okay, so here as we understood that we are going to maintain the capital accounts of the partners, and when you finally drop the capital accounts, we come to the closing balances of the capital, and these closing balances have been arrived after you have made the adjustments relating to, okay, the goodwill, sharing of the goodwill, sharing of the general reserve amount, and also sharing of the profit or loss on the revaluation. Then later whatever the balances which has been drawn up, we take them and we carry them forward to the balance sheet. But it so happens that sometimes it will be given in the question that the old partner's capital should be adjusted on the basis of the new partner's capital, or sometimes the adjustment will be with regard to the new partner's capital itself. He will not give what is the amount of the new capital which is to be brought by, but he will say that the new partner is going to get, okay, the capital on the basis of, like as a percentage of the old partners combined capital, or it could be as a fraction of the old partners capital. So first we are going to see how the old partners capital have to be maintained on the basis of the new partners capital. I hope you all got the point. Did you all follow? You can speak, children. Did you all follow?
Yes, ma'am.
Okay, I just
Yes,
want that consent so that I can proceed further. So now Surya and Chandra sharing profits in proportion of 3/4 and 1/4. So here the old profit sharing ratio is 3 is to 1, and furnish their balance sheet on 31st of December 2010 as follows. So as you can see, there are liabilities followed by the assets, and you can also see very much on the liability side there is a general reserve balance. So whenever there is a general reserve balance, that reserve needs to be divided between their partners or among the partners depending upon the number of partners. Now they admit Tara into the partnership on 1/1/2011, that is at the beginning of the year itself, on the following conditions. So what are the conditions here? Tara is going to pay 30,000 as capital, and he is going to get, okay, 1/5 share in the future profits. This is one point. Second is he's also going to bring 40,000 as the goodwill. Fine. And the stock and the furniture to be reduced by 10%. So this is something relating to the revaluation of the assets and the liabilities. Followed by, there is also a provision for the doubtful debts to be maintained, okay, on debtors at the rate of 5%. Then there is also a revaluation made, okay, towards the land and buildings by appreciating the asset by 20%. Okay, so the point number 3, 4, 5 are relating to the revaluation. Okay, then followed by, now this is the sixth point, is very, very important, children. Have a look into this. The capital accounts of the partners. So the capital accounts of the partners is said, that is, the old partners is talking about, be readjusted on the basis of their profit sharing ratio and any additional amount to be debited or credited to their current accounts. So here, whenever the current accounts are to be maintained, I hope you all know very well by this time that we need to maintain, I mean, the capital accounts, if it is to be maintained fixed, then we are going to maintain what, the current accounts. So anything which is relating to, okay, I mean, the adjustment towards the capital, and this adjustment of the capitals have to be made on the basis of the profit sharing ratio, he said. So when he said profit sharing, he means that it is on the basis of the new profit sharing ratio, because whatever the profit, I mean, the capitals which they already have in the, I mean, the business, that is as per their old profit sharing ratio. And because they are going to take, Tara as a new partner into the firm, so on the basis, I mean, after he joins, certainly the new profit sharing ratio of the partners is going to be changed. So according to that, new profit sharing ratio, what should be the capitals of the old partners, and therefore these capitals needs to be adjusted on that basis. Okay, so here I will slightly try to change, I mean, made a little modification to the question. Let us not go with the current accounts, let us just go directly with the capital account, so that initially you will not lead into any sort of confusions. Okay, so now let's go with the solution here. We need to have a Excel sheet. Yes. Now let's go with the first. Let's finish with the journal entries. So first, let's have a look into Is it fine, children? So I'm going to make the journal entries, but before I do the journal entries, first let us go with the calculation of the new profit sharing ratio. Has anyone done the new profit sharing ratio calculation? Where did I go? Yeah, this is the one, right? Yeah. So the old ratio here is 3 is to
1.
1. So on that basis, let us first find out the, here I'll do it so that let's not have any, okay. Old ratio 3 is to 1, right? So to calculate the new profit sharing ratio, so how is that you are going to calculate the new profit sharing ratio? Old share into
Remaining share of profits.
remaining share of profits. Yes. Remaining share of profits. So here, let's go with calculation of, yeah. Now who's the first partner here? Surya's share of profit. Before we do that, first find out what is the remaining share here. Remaining share is equal to, now as the new partner is to be given 1/5 share in the profits, so 1 minus 1 by 5. So 1 minus 1 by 5, what is the remaining share?
5 by
4. Yeah, what is the remaining
4
share?
by 5.
No,
4 by 5.
4 by 5. 1
Yes.
minus 1 minus 1 divided by 5. No, so from one apple, okay, if one apple is going to be cut into 5 pieces, let us assume, okay. So if you remove one piece out of that, how many pieces will be left over? How many pieces will be left over? Come on. See, if one apple is cut into 5 pieces, 5 even pieces, out of that if you remove one piece, how many will be left over?
4 pieces.
4. So please keep in mind that whenever you look into the fraction of the new partners, share in the profits, whatever is in the denominator, so that many shares, the profit is going to be divided into. So therefore, the remaining share here is going to be 4 by 5. Now to calculate Surya's share of profit here, what is that we are going to do? Okay, it is his old share is 3 by 4 into the remaining share
4
here
by
is
5.
4 by
4
5.
by 12 by 20.
12 by 20. Yeah. So how much here it will be? 12 by, right? It is accepting it as date. Okay, here only we will do. Equal to 12 divided by 20. Here also, I think it's taken as a date here, 4 by. So let me put it as here. It's equal to 4 divided by 5. Okay. So now let's move to the next partner, that is Chandra. Chandra's share of profits. Equal to, that is 1 by 4
1 by 4 into 4 by 5.
4 by 5. How much it will
4
be?
by 4 by 20.
4 by
20. 4 by 20.
Very good. Now let us take the new partner also. That is Tara. So Tara's share of profit. So as he is to be paid 1 by 5.
1 by
Now
5
to
into
to
4
make
by
the
4.
denominators common, we have to multiply 4 by 4.
4 by 4.
Is equal to 4 divided by
20.
20. 20, ma'am.
it. So what I'm doing here is, let us further simplify if you want. The ratio here is 12 is to 4 is to, it is 4 again. So this can be further simplified as
3 is to 1 is to 1 is to 1.
1 is to 1. Okay, now I did not write 1. Got it? So this is a new profit sharing ratio for all the partners. Now what we need to do here is further calculation of profit, the capitals. Calculation of capitals. Calculation of old partners capitals. You can write old partners capitals on the basis of sharing ratio. Okay, now here as you have seen the new partner is bringing 30,000 as is a share of profit. Okay, 30,000 as a share of capital for a profit in a share of 1. So 3 plus 1, 4 plus 1, 5. So for a 1/5 share in the profits is bringing how much here? 30,000. So let us calculate how much it is going to be for the remaining partners. So here let us first calculate Surya's capital. So Surya's capital equal to, now his new profit sharing ratio is 3/5, right? So for, and the new profit share, the new partner's share in the profits is 1/5. I'm talking about the new profit sharing ratio only, children. So for 1, if Tara is going to, okay, get 30,000, that means for 1 share in the profits, if he is going to bring 30,000 as as a capital, how much should be for 3? For a ratio of, or for a proportion of 3 parts in the profits, what should be the capital of Surya?
18%.
Huh? How much it will be?
90,000.
90,000.
90,000.
Hence, his capital should be maintained at a 90,000 into the firm. Got it?
Okay, ma'am.
Next. Followed by, who's the next partner? Chandra. Chandra's capital equal to, now Chandra is again how much? Same 1. So for 1, if Tara is bringing 30,000,
30,000.
actually this is not required, but still let's do it. Again for 1, how much it will be?
30,000.
So his capital should be 30,000. So you need to maintain what? 30,000. So if you just see the last point here, the capital accounts of the partners be readjusted on the basis of their profit sharing ratio. So this is how the profit sharing ratio has been calculated, and on that basis we have calculated what should be the new capitals of the partners, and any additional amount be debited or credited. Okay, that means suppose if the amount is excess, it will go to the current account. If the amount is less also, it should go to the current account as a negative balance, or as a positive balance. So how that is really going to happen, we will see it. Okay, because unless and until you complete the ledger accounts, okay, we cannot go with the, I'll put it here only, there is some formula is accepted. Done, children. Now let's go quickly with the journal entries. Now the first journal entry here will be for the capital introduced by the new partner. So that is here the new partner is Tara. So here the capital of Tara. So Tara's capital account, and the amount here is going to be I want to take 2 amount columns so that this is not required also. Let us remove. Okay. Right. So Tara has got 30,000. So being capital introduced. Now coming to the goodwill here. Now can anyone tell me what is a case of goodwill here? There are 3 cases for the goodwill to be treated. So which case are we going to apply in this case, in this one? Here the new partner is bringing goodwill in cash. That's very much clearly mentioned. But what you need to identify here is the goodwill is going to be withdrawn by the old partners, or is it going to be retained in the business by the old partners?
It's retained.
It is retained. Very good, because whenever nothing is being mentioned towards the goodwill here, it is always okay to be retained in the firm itself. So when it is going to be retained, we write the entry as first cash to new partners capital, and the amount of the goodwill here is 40,000, and here also it is 40,000. Then followed by the new partner is Tara, so Tara's capital account to the old partners.
partners.
So who are the old partners here? The old partners are
Surya and Chandra.
yes,
Chandra.
Surya and Chandra. And because we do not know what is their I mean the sacrificing ratio, because in this case the sacrificing ratio is not required to be calculated, because the fraction of the share in the profits is being mentioned. So therefore the old ratio as well as the sacrificing ratio remains the same, because you have already seen the new profit sharing ratio here is 1:1, and the old ratio is also 3:1. So therefore it is almost the same, so there is no need for you all to calculate the sacrificing ratio. So in this case the new partner's capital to the old partner. So here the old partner is the Surya, then followed by here we'll have 2 Chandra. Okay, now divide this amount, that is 40,000 in the ratio of 3:1.
30,000, 10,000.
Very good. 30,000 and 10,000. Right. So I'm not continuing with the remaining this thing, but it's not required at all. So let's delete them. Then moving further to the next. This is also not required. So let's go with the revaluation. So what is the revaluation here? The stock and the furniture to be reduced, and there is also a provision to be maintained for the doubtful debts. So what we are going to do here is, now because all the three are considered to be as a loss, okay, because there is a reduction in the value of the asset, so therefore revaluation, okay, account debit, I'll clearly mention it as 2. First one is stock, followed by 2 furniture, and 2 provision for it is doubtful, and I can also mention the percentage, right? Now coming to the next, so that is calculating the amounts. So what is going to be the stock now? The stock here is 10%, is it? So already the balance sheet value is 40,000. So 10% of that will be 4,000. Okay. Yeah. The next furniture is also to be reduced by 10%. So the furniture here is 11,000. So we take it as 1100. Okay. Then 5% of on debtors. So the debtors value here is 16,000. So 16,000 ka 5% will be
800.
So therefore the total amount to be debited to the revaluation is 5,900. 900. Right? Then coming to the next one, that is there is an appreciation towards the land and buildings. So here the land and buildings account, it is debited to revaluation here. So valuation, and how much is the percentage? 20. So 20% of 35,000.
7,000.
7,000.
That's it. So we have almost done with the all the journal entries. Okay, now before we go for the preparing of the ledger accounts, we should also transfer if there is any general reserve, right? So here we have a general reserve, and the amount of the general reserve here is 8,000. So therefore this amount will be transferred, okay, to the capital accounts of the partners. So how we are going to transfer this amount now, in which ratio?
3:1.
3:1. Good. So now divide this amount and quickly tell me the total. I mean, how much is
6,000, 2,000. 6,000, 2,000.
anything else? So I think we can now go with the ledgers. So let me quickly copy the ledger accounts, whatever is required. Yeah, this is what so take the revaluation account, balance sheet. Wait, it's not showing me. What is this number? 12. Yes. Then next we have back. Now we have the capital accounts of the partners as this is capital accounts here. It is 60,000. Then we also have cash balance as and cash account here. To balance brought on as 22. That's all I need to delete. Just a minute. Only a moment. So that so evaluation. So coming to the first journal entry, the first journal entry here is cash to Tara's capital. So in the cash account, we are going to write it as to Tara's capital, right? Cash to Tara's capital, and the amount of the capital here is 40,000. And The same thing will be posted to Tara's capital as by
Cash.
Next again we have cash to goodwill. So cash to goodwill. Here is 30. Sorry. So let me first this. Then cash to goodwill is 40,000. Okay. So here again to Tara's capital. This is 30,000 and this is 40,000. The same make for this. This is thousands and again by cash. It's goodwill. He got 40,000. Right? I hope it's clear. So the first entry is for the capital. So capital is here on the top. So the first entry is for the capital. The second one is for the goodwill. So both has been posted into the cash account as well as the Tara's capital account. Now going for the sharing the goodwill to both the partners. So here the entry is Tara's capital to old partners, that is the new partners capital to the old partners. So in the new partners capital we write it as 2, right? That is as well as Chandra. So Surya and Chandra, and the amount of share to them is 30,000 and 10,000, right? And as well in their capital accounts we put it as by Tara's capital account. So in this capital here it is 30,000 is Surya's share in the goodwill and 10,000 is Chandra's share in the goodwill. So we made the postings of the goodwill also. Now coming to the revaluations here. So revaluation to all the assets. So here to stock, to furniture and to provision for the debtors, that is 4,000 followed by 1100 followed by 800. Okay, then we have land and buildings. So here I'll just add it as land to this because we already have. So land and buildings, and the amount here is 7,000, right? Then followed by sharing the general reserve to the capital account. So therefore here in the capital accounts of the partners, so by general reserve, 6,000 and 2,000. So first let us close the revaluation account and see whether there is a profit or a loss on revaluation. So as you can see that the debit side total is 5,900, whereas the credit side total is 7,000. So the credit is more. So if the credit is more, there is a profit in the revaluation. And yeah, how much is the profit now?
1,100.
1,100. So if this is to be shared in the ratio of they have not mentioned here. So if this is to be shared in the ratio of that is 3:1, now tell me how much each partner is going to have his share in the revaluation.
825.
825.
275.
The same thing here we are going to post it in the capital accounts. So by revaluation, that is 825 and 275. That's it. Okay. So now let's see the capital accounts, because as we have already understood that the to balance carried down or by balance brought down, whatever it is, let's take the total of the partners, right? So here to balance carried down. Now what should be the capital of Surya? The new capital of Surya is 90, Chandra is 30, and this is 90, 90, 30, and 30. Now find out. I think Tara's capital is exactly, I mean, there should not be any change in his capital, but let us see what is the total here. That is 96,000 is onto the credit side, and here 44,275. Okay, did you understood what I was trying to do in the capital accounts? If you see the total onto the credit side, okay, the total onto the credit side of Surya is 96,825, but he is supposed to maintain, okay, a balance of only 90,000 in the capital account, and whatever is the difference, because if you are going to maintain only 90,000, there will be a difference of 6,825. Okay, so this 6,825 will be transferred to current account. That means it will be maintained in the name of his current account. Is it tallied now? So similarly here, he is supposed to maintain only 30,000, but he's having a balance of, excess balance in the capital account is 14,275. Yeah, 275. So this is also to be maintained. This excess balance is to be maintained in the name of a current account, but this amount should not be retained in the capital account. This is what he was trying to tell. Whether the balance could be either a debit balance or either a credit balance. But here this is a credit balance because from the capital account we are transferring to the current account. So current account is showing a credit balance. Suppose for example, let us think the balancing figure here is more. Okay, now let us take for example 50,000 is supposed to be maintained by Chandra in the firm, but here he's having only 44,000, 275. That means his capital account is falling short of. So that means he's actually supposed to bring the capital to maintain to that level, but that balance here we are going to transfer it onto the credit side as by current account, and the current account will show a debit balance in the balance sheet. Hope you all understood now. Why here there he mentioned it as debit or a credit. Now let's go with the balance sheet. So in the balance sheet, now first quickly let us take the total of the cash here. So the cash is 92,500. And I'm going with the remain. Here actually I wanted to tell one important point, how we are going to prepare the balance sheet by looking into the revaluation account, because always the revaluation account forms as a basis for the preparation of the, I'm just copy it here. What happened? And something came in between. Valuation account. So I'm just trying to take this. Let us keep it beside the, yeah. Now, first we have already got the cash amount. Now let us also have a look into the balance sheet so that we can pick up the amounts from here. So in the balance sheet we have what the bills. So bills we did not change anything. So the bills is going to remain the same. Here bills receivable. Writing in the order because I already have the items. So bills receivable is 13,000. 1 minute. Bills receivable is 13,000. We didn't change that. Now debtors is actually 16,000. So from the 16,000 we have 800 to be deducted. So 15,200 is a balance of the debtors here. Then stock here is 40,000. So on this 40,000 we maintained, right?
4,000.
Yeah, let me even take furniture. We don't have plant and machinery here. With furniture was disturbed, so 11,000. Buildings here was 35,000. Anything else apart from this? Cash, bills, data, stock, furniture, land and buildings. And on this side we have creditors. Creditors, no change in the value, so that is 37,500. I'm going to remove all this. Apart from the creditors, there's nothing else. Okay, now, yes. So here, now have a look into the revaluation. Whatever is being debited, we are going to reduce it from the concerned asset. So there was a reduction towards the stock. So we need to minus 4,000 from here. Therefore, the balance of the asset is going to be 36,000. And there is also a reduction from the furniture, that is less depreciation to the extent of 1100. So if you minus 1100 from this, what will be the balance of the asset here?
9,900.
And next we have provision. So provision I have already deducted 800 from that, and there is an appreciation towards land and buildings. So here land and buildings to be appreciated by 7,000. So after adding 7,000 to this, the asset value will be 42,000. Right? This is done. Now coming to the capital accounts. So what are the capitals here? The capital accounts of Surya and Chandra and Tara. Let's take it in the balance sheet. So they need to maintain. So either 90,000. This is 30,000. This is also 30,000. Now, apart from this, there are current accounts. So both the current accounts are credit. So 6,025 and 14,000. Let me take this. Here, Surya's current account 6,825. Chandra's so this is 1 lakh 20 plus 30 50, right? So 1,50,000 in the outer column for the capitals. Going to be 121,100, right?
Yes, ma'am.
Okay. So let's check the total. 2,68,000. I hope it tallies. So there's a difference of some 60,000. exactly 60,000. Anything 60,000. What is the total? 2,08,000.
Ma'am, tallied, ma'am.
एक minute. There's something went wrong. I don't know. 60 tallied.
Yes, ma'am.
No, this side I got. Why it is showing us 2,68,000 then? Do it manually and see.
Yes, ma'am. 2,08,600.
There is some formula problem. Okay, done. So I hope everyone has followed this, and I have also recorded the class. So I will share the recording with you all. In case if you want to listen to this again, you can, right? So I'm just stopping the recording. So
Ma'am,
thank
can
you,
you share
children.
the answer?
Thank you, children. 1 minute.